Welcome, class, and settle in. Today we are going to walk step by step through a definitive explainer of the 2025 Business Planning Taxation Rules. Think of this as your master blueprint. We're going to take our time and methodically build your structural understanding of the UK tax system, so when you walk into that BPT exam, you're doing it with absolute rock-solid confidence.
Okay, so here's our roadmap for today's session. We'll start by locking down the foundational income tax computation. Then we'll move through property rules, national insurance, and tax-advantaged investments. Finally, we'll wrap up with my favorite part, dodging those sneaky examiner traps. Let's get right to it. All right, Section 1. This is the absolute core of personal tax. We really need to take our time here because you need to understand the strict chronological logic, not just the numbers. If your foundation is wobbly, well, the whole house comes down.
Walk through this structure with me. It's a very strict six-step waterfall. First, you slot your income. Second, you calculate your net income by applying deductions. And remember, things like trading losses must go strictly against your non-savings income first. Third, you deduct that personal allowance. Fourth, you apply your tax rates to figure out the actual liability. Then, step 5, you subtract any tax reducers. And finally, step 6 is where you apply double tax relief to land on your final tax payable. You absolutely have to follow this exact order.
Let's zoom in on step 1. You've basically got 3 buckets, and you have to slot every single source of income correctly: non-savings, savings, and dividends. Non-savings is your trading income, your salary, property, and, don't forget this one, pensions. Savings income is exactly what it sounds like, plus gilts. And lastly, UK dividends and unit trust dividends drop into that final bucket. Keep them completely isolated from each other, because as you know, they trigger totally different tax rates down the line. Now, as a candidate, you've just got to know these 2024/25 figures completely by heart. The examiner isn't going to hand them to you on a silver platter. You need instant recall. Personal allowance is £12,570. Basic rate band is $37,700. For non-savings, know your 20, 40, and 45% brackets. And please, memorize those specific dividend rates: 8.75, 33.75, and 39.35%. So, I really want you to focus on this percentage right here, 60%. This is the infamous effective marginal rate trap, and I guarantee it's a massive planning point for your exam. You might be wondering, why 60%? Well, it's pretty brutal. When you earn between £100,000 and £125,140, you hit a vicious trap. For every £2 of adjusted net income you make over that 100K threshold, bam, you lose a pound of your personal allowance. So you're paying your normal 40% higher rate tax plus an extra 20% from that lost allowance. This is exactly where throwing money into a pension or making a gift aid contribution becomes an incredibly strategic move to pull that income back down. So how do we mitigate that trap? You extend the basic rate band. But listen closely, class, here is the golden rule. You always extend that band by the gross amount, never the net. If your client pays $8,000 into a pension, you divide that by 80% to find the £10,000 gross figure. That gross amount is what actually pushes your basic rate band higher. And a quick side note, don't forget this also pushes the higher rate band up by the exact same amount. Moving calmly right along into our second section, let's untangle some of the very specific rules around property income and take a look at the underlying architecture of national insurance. When you're dealing with landlords, you have to keep 2 key reliefs totally separate in your mind. On one side, you have the rent-to-room relief. It's a nice, simple £7,500 exemption. Super straightforward. On the other side, though, you have the replacement furniture rules. And here's the catch. This relief literally never applies to initial furnishings. If your landlord furnishes a brand new flat, they get nothing. Zero. You only get relief when you are replacing something already there, like swapping out a broken sofa, and you even have to subtract whatever you sold the old sofa for. Let's shift to Class 1 national insurance. Take a look at this deliberate misalignment. Employees start paying their NICs at £12,570, which nicely lines up with the personal allowance. But the employers? Yeah, they start getting hit with their 13.8% at a much lower threshold, £9,100. The examiner absolutely expects you to catch that little gap where the employer is paying tax, but the employee isn't.
Okay, let's talk about the employment allowance. It's a fantastic £5,000 reduction for employers. But look really closely at condition 2. You have to play detective in your exam questions. If you see a sole director company where that director is the only employee earning above the threshold, you need to call them out if they try to claim this. They can't do it. And just as a quick reminder, this allowance doesn't touch Class 1A on benefits or Class 1B on PEYE settlement agreements. Those are entirely separate 13.8% charges.
Now, for the self-employed folks, Class 2 is pretty much a ghost for 2024-25, effectively abolished. However, making a tiny voluntary payment of £3.45 a week is still a really smart move for low earners to protect their state pension down the line. Meanwhile, Class 4 is where the real tax happens. It's a mandatory hit on adjusted profits, 6% in that main band, and then dropping down to 2% once you cross the upper limit of £50,270.
Let's transition into Section 3. We're stepping out of the day-to-day income rules and into the tax-advantaged worlds of individual savings accounts and, of course, those high-risk, high-reward venture capital schemes.
So looking at individual savings accounts, the big overall limit is still $20,000 a year. But here's what's cool for 2024. You can now split that limit across multiple providers of the exact same ISA type in a single year. Lots of flexibility there. Don't gloss over the lifetime ISA either, where up to $4,000 gets a sweet 25% government bonus. Naturally, all the income and gains inside these wrappers are totally tax-free. But also, keep in mind that surviving spouses get a really valuable inherited ISA allowance when their partner passes away.
I cannot stress this enough, class. You must memorize this table. This is the holy grail for comparing these schemes. Notice how SEIS gives you a whopping 50% income tax relief, capped at £200,000. EIS gives you 30%, but up to a massive £1 million. VCT sits at 30% on $200K. But the real trick? Look at the dividend row. VCT dividends are tax-exempt. EIS and SEIS dividends, fully taxable. Examiners absolutely love testing to see if you remember that little distinction. Look closely at the capital gains treatment here because the structural difference is huge. On the left with EIS, you're really just kicking the can down the road. You're deferring a capital gain, and when you finally sell those EIS shares, that old gain crystallizes and comes right back to bite you. But over on the right with SEIS, it's a totally different ballgame. 50% of your reinvested amount is completely wiped out. Poof, gone. It's a permanent exemption, not just a delay. Also, keep a very sharp eye out for knowledge-intensive, or KI companies in your exam scenarios. The government desperately wants to encourage research and innovation, so they stretch all the normal rules. Everything just gets bigger. The employee cap jumps from $250 up to $500. Gross assets limits double to £20 million. The maximum an individual can invest in EIS doubles to $2 million. It's incredibly generous if a company qualifies. Finally, we've reached the climax of our masterclass. Section 4. Knowing the rules is only half the battle. The real trick is knowing exactly how the examiner is going to try and trip you up. Let's get inside their head. You should literally be asking yourself this question every time you look at a practice scenario. The exam is purposely built around very specific technical blind spots. So let's illuminate those blind spots right now so you don't fall into them. Let's review the classics. Always check adjusted net income to spot that 60% trap we talked about. Remember to always extend the basic rate band using the gross amount. Don't forget that the 0% starting rate for savings completely vanishes if your non-savings income is over $5,000. But here's the sneakiest trap, the Section 64 loss mismatch. If you claim a trading loss against general income, it saves you income tax this year, but it does not save you Class 4 NIC this year. For NIC, you have to carry it forward. It's a deliberate timing mismatch designed to catch you off guard. And here's part 2 of your danger list. Remember that rule about sole directors not getting the employment allowance? Remember that only VCT dividends are exempt. Now this next one is crucial. If an EIS investment goes bust and you want to claim a capital loss, you have to subtract your initial 30% income tax relief from your base cost first. I mean, you can't claim a loss on money the government already refunded you, right? Lastly, just know that Scottish rates exist. They run from 19% to 48%, but don't waste your precious brain power memorizing their exact bands. Take a slow read of this quote. I really want to hammer this home because it's a fundamental truth of the computation architecture. The savings and dividend nil rate bands are bands. They are not exemptions. That means they sit inside your computation and they still eat up your rate thresholds. If a basic rate taxpayer uses their £1,000 savings nil rate band, that £1,000 still physically pushes their other income closer to the higher rate threshold. Treat them like buckets that just happen to be taxed at 0%.
You are now armed with a highly structured architectural blueprint. You've got the analytical tools to break down these scenarios. So, class, knowing the deep mechanics of the 60% trap, spotting those deliberate NIC mismatches, and mastering the venture capital nuances, the only question left is this. When you sit down in that exam hall, are you going to let the examiner set the traps, or are you going to outsmart them? Study these rules, internalize the logic, and I know for a fact you will crush BPT 2025. Good luck.